The market is currently closed ahead of the opening bell on Thursday, July 30th, 2026, with Microsoft Corporation trading at a regular session closing price of $390.54 recorded on July 29th, 2026, followed by a dramatic jump past $421.10 in late after-hours trading after releasing fresh earnings results. Wall Street expected another quiet quarter weighed down by massive capital expenditure anxieties, but the numbers revealed a massive narrative disconnect. While institutional investors spent months worrying that enterprise artificial intelligence spending would drain margins without delivering near-term returns, Microsoft just demonstrated that its cloud backbone is monetizing faster than almost anyone anticipated. If you look at mainstream sentiment across popular investing sites and social channels over the past 2 quarters, the consensus surrounding Microsoft stock was surprisingly cautious. Analysts repeatedly questioned whether spending tens of billions on infrastructure and hardware partnerships would squeeze free cash flow and compress valuation multiples. The surface story suggested a tech titan overextending itself in a costly arms race. The reality beneath that narrative is far different. Microsoft is quietly pulling ahead by turning raw compute demand into immediate recurring enterprise revenue, proving that its enterprise footprint creates a structural moat that pure hardware providers simply cannot duplicate. To understand why this momentum is shifting so fast, we have to look closely at recent trading behavior and daily price swings. Heading into the end of July 2026, Microsoft stock had experienced notable volatility, pulling back nearly 29% from its previous peak of $555.45 and oscillating near its 52-week low range around $349. Volume surged well above its average daily levels as institutional accounts rebalanced portfolios ahead of the fiscal fourth quarter report. The broader technology sector was feeling the squeeze from rising treasury yields, macro uncertainty, and lingering fears that enterprise software budgets were being reallocated. Yet during that exact window of hesitation, smart money was quietly accumulating positions through individual brokerage accounts and institutional funds. Look at the options market and order flow patterns across platforms like Interactive Brokers and the Interactive Brokers platform during the days leading up to the release. Call volume began spiking as traders positioned for an upside move, recognizing that the market had priced in far too much pessimism regarding Azure cloud growth. When the official figures landed, Microsoft reported revenue of $90.01 billion against expectations of $87.61 billion, alongside earnings per share of $4.74 compared to the $4.24 consensus. That massive beat sent shares surging roughly 8% overnight, shattering the narrow trading range that had trapped the stock for weeks. This kind of immediate repricing forces both retail traders on the Robinhood app and sophisticated wealth managers to rethink their allocation strategies. Whether you manage your own portfolio through Robinhood stock trading, rely on SoFi Invest, or use automated rebalancing like Schwab Intelligent Portfolios, observing how big tech leaders bounce back after earnings surprises is essential. Many investors holding Apple stock or Nvidia stock watched closely because Microsoft's cloud performance serves as a primary barometer for overall enterprise software demand. Please take a second to comment below how many shares of Microsoft stock you currently hold in your portfolio, or if you are waiting for a pullback before adding more. To fully grasp how Microsoft reaches this level of cash generation, we need to examine what the company actually does at its core. Beyond its historic roots in personal computer operating systems and office software, Microsoft operates across 3 core business engines: productivity and business processes, intelligent cloud, and more personal computing. The Intelligent Cloud division, anchored by Azure, serves as the primary engine for top-line expansion. By integrating business productivity software with high-performance cloud processing, Microsoft creates an ecosystem where corporate clients rarely switch to competitors. The friction of moving away from Microsoft 365, Teams, and Azure infrastructure is simply too high for most global enterprises. When individual investors seek investment help or explore self-investing options through platforms like SoFi Active Investing or the Fidelity mobile app, Microsoft often tops the list of foundational core holdings. The company's balance sheet remains one of the strongest in corporate history, holding a rare AAA credit rating that gives it unmatched flexibility during tight credit cycles. This fiscal strength allows management to fund immense infrastructure build-outs internally without taking on dangerous debt levels, insulating shareholders while smaller competitors struggle with rising capital costs. Looking at the competitive landscape, Microsoft occupies a unique middle ground. While hardware manufacturers sell the underlying infrastructure, Microsoft translates that compute power into direct business solutions. When market participants trade Robinhood fractional shares or set up automated contributions through a SoFi robo-advisor, they are often buying into a business model that captures value at every level of the digital stack. That durability is precisely why long-term wealth advisors consistently feature Microsoft in diversified portfolios alongside broad market index products and Fidelity ETFs. Recent macroeconomic headwinds have certainly tested market confidence. Inflation fluctuations, interest rate expectations, and shifting corporate spending habits have all contributed to sharp sector rotations over the past year. During periods when tech valuations compress, retail platforms see shifts in user activity, whether through Robinhood crypto trading, SoFi stocks, or traditional Robinhood investments. Yet through every market swing, Microsoft's underlying cash flows have remained remarkably resilient. As we look toward the future outlook, several key catalysts and risks will determine where Microsoft stock goes next. On the opportunity side, accelerating adoption of automated enterprise tools and expanded cloud contracts offer significant upside runway. The ability to upsell existing enterprise clients to higher-tier subscriptions creates an expansion path that requires minimal incremental acquisition costs. However, risks remain. Regulatory scrutiny across international markets continues to present ongoing compliance hurdles. Furthermore, if global macroeconomic conditions soften significantly, enterprise clients could slow down the pace of new cloud spending, potentially cooling growth rates in upcoming quarters. This setup brings us right back to the tension between market expectations and fundamental reality. Wall Street expected heavy infrastructure costs to drag down performance, viewing the stock with skepticism and pushing its price towards multi-month lows. The reality is that Microsoft demonstrated how large-scale investments convert to record-setting revenue and earnings beats. For investors managing funds through a Fidelity brokerage account, building retirement strategies inside Fidelity IRAs, or analyzing execution through interactive broker stock trading, the key takeaway is clear. Short-term sentiment frequently misprices long-term operational execution. Navigating these shifts requires staying focused on core business metrics rather than daily market noise. Whether you conduct online investing through a Fidelity trading platform, manage positions with SoFi Invest, or trade on Robinhood cash management features, maintaining a clear understanding of enterprise value creation is paramount. Microsoft has once again shown that when execution meets massive enterprise demand, reality can quickly shatter even the most cautious market expectations. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thumbs up. Don't forget to like, comment, and share this video to support the channel.